Gagan, and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, now part of Sapiens. Release your underwriters to underwrite with the Sapiens Advantage Go underwriting workbench. Today's guest has a job that is almost unique in the global insurance industry. That's because his organisation has been formed through a unique exercise that split a standard insurance company into an MGA in charge of underwriting and a balance sheet in charge of allocating capital to risk. All this means that Dan Burrows, Group CEO of Pelagos Insurance Capital, is probably the only pure capital allocator in existence. There are lots of investors in the global insurance market allocating capital to insurance companies, but they are many steps removed from the risk and are only likely to review their allocations annually. What's unique about Pelagos is that it's much closer to the underwriting process, reviewing risk and capital decisions in almost real time. To paraphrase economic terms, whereas most investors in insurance are macro, Pelagos is very much micro. It takes some unique qualities to pull this kind of thing off, and that's what makes this podcast so fascinating. Dan is a unique character in a unique job, with a unique perspective on the market, and I'm sure that some of what you're about to hear will surprise you. In this podcast, we examine the rebrand to Pelagos, the maturing of the long-term relationship with the Fidelis partnership, and diversification into other underwriting channels, the prospect for profitable trading as the market becomes more competitive, thoughts around carrier M&A, as well as the big questions such as the best applications of AI in insurance and the seemingly relentless advance of portfolio solutions underwriting. Dan is calm, softly spoken and thoughtful, but is also razor sharp and able to provide instant feedback or pushback. In short, he strikes me as the ideal foil for smart entrepreneurial underwriting teams. This is an engrossing and revealing encounter, which I can highly recommend to anyone. Enjoy the podcast. Dan, welcome back to the Voice of Insurance.
Thanks, Mark. Great to see you again, and welcome to our office.
Yes, and as I came through the door, it said Pelagos. So tell us all about that rebrand. What was the rationale behind it?
Well, great question to start with. We always intentionally felt that a rebrand from Fidelis, which has been a very successful...
I remember I did an interview with you and Richard in Monte Carlo about 4 years ago, just when this bifurcation was happening, and it hadn't happened yet. I asked you what about the brand? I just assumed that you would end up with 2 different names. You said, well, yeah, we can't say what it is yet. And then it was, you were Fidelis Insurance Group and there was the Fidelis partnership. So you'd kept the same name now. Is it just that it's the right time to give yourself a different name?
Yes, I think fundamentally it is about the timing. That's very important. We've been very proud to be associated with the Fidelis brand, very successful over the last decade and a bit more than that. But now is the right time to give clarity. I think that's one of the important messages we want to give to all of the stakeholders, be it investors, brokers, clients, the staff, just clarity around the independence of the business, our strategy and what that means. So communicating the clarity is really one of our strap lines at the moment.
And is it just a reflection of a maturing in your relationship? I've noticed a few announcements recently of partnerships that are not with the Fidelis partnership. Are you giving the pen to other people? Is it just a way of reflecting that reality that, you are absolutely 2 different organizations, although you have an incredibly intense and close relationship? Is that the right way of describing it?
I guess so. I step back and just think about the origination of the brand Pelagos, obviously from the Greek word archipelago.
And it's the sea, isn't it?
Yeah, the sea, a community of islands. And that's how we see ourselves, is the connection between not only our own staff working in teams across 3 global locations, coincidentally all in islands, in Dublin, London and in Bermuda, but also the broader partnerships that we can bring together, and that's client, broker, banker, investor, analyst. But working together, it just makes Pelagos such a much stronger brand. And that's really been the catalyst for that change. Fidelis will always be our core partnership, but now we're being able to develop new partnerships with other excellent underwriting teams. Very high benchmark in terms of quality, what we're looking for in terms of characteristics with our partners. But we're very excited about that.
I suppose Pelagos is Greek and Fidelis is Roman, isn't it? So there you go.
Yeah. Well, no, we're very proud of the journey we've taken, but it's been a very interesting reaction in the market in terms of now getting clarity out there that actually you are independent and you are looking to do business with new partnerships.
I think it makes it really clear, doesn't it?
Yeah, absolutely. So we've seen a real uptick in opportunity since we announced this on the last earnings call a few months ago, and we're working through that pipeline. We don't have a big hit ratio. We're very selective about what we do and who we do it with. There's a cultural fit as well as hitting the performance metrics that we're looking for, set by the partnership, that high benchmark I just referred to. But we're very excited about the future.
And I suppose, of course, what you're available to pick is also what the Fidelis partnership probably doesn't want to do, I suppose, isn't it? It has to correlate with something that is not something that they want to do, because obviously your first preference would probably to do it with them, wouldn't it? If it was a class of business or I don't know, am I putting words in your mouth by saying that?
I think there's room for both. And I think certainly the partnerships we've looked at thus far are very complementary to what we've got.
And of course, if they weren't, you wouldn't look.
Exactly. But there is also very few people get to see the whole market. So having different access through different distribution networks gives us a broader view of the market. So I'll give you a specific example. And you look at the mortgage portfolio, the partnership have been very successful looking at international business, European. We partnered with Euclid, led by Jay Moynihan, someone I worked with at Aon for many years and has been at the forefront of the mortgage reinsurance market. But he has access, when he set up a couple of years ago, to the US mortgage market. So bringing those two bits together has been very complementary in building out the portfolio, more diversification. So that's the type of thing we can do. But it's a much broader set of criteria that we work with to make sure that there's a cultural fit, economic fit, that we're aligned. And those things are equally as important.
And I suppose you already know what a really good cover holder relationship looks. You've got one excellent one.
Oh,
so I suppose,
yeah.
you think, can we have a relationship that is as connected as the one you've already got?
Oh, yeah. We've learned so much in the last, as you would imagine we have in the last 3 years. The partnership have been very successful, even in the 3 years since we've set up. Since 22, our gross premiums grown by about 50%. There's much more than 100 different product lines. I think the partnership is closer to 150. We don't support every product line, but you learn a lot about the complex relationship between capital, allocating capital to the right risk selector, and what you actually need as a business. What should you be looking for when you make these connections with underwriting teams?
Do you have any kind of plan in your mind about what percentage of your gross written premium will come in through third parties? Well, they're all third parties, but through parties who are not the Fidelis partnership at some point.
Yeah, we don't actively talk about setting targets. We have talked on earnings call recently about somewhere in the 25% to a third over the next 2, 3, 4 years. But we don't want to put ourselves under pressure into being forced into
It's more organic. It's sort of, if you'll know it when you see it, and then you'll look at the numbers afterwards rather than before.
But look, there are lots of good underwriters out there doing great things in the market. But it's not always just about that. As I said, it's got to be alignment culturally, because we're going to be on top of you. We're going to want to be involved in the day-to-day decisions. We're going to want to have access. We're going to want to think about how you take on risk, and does that work for us? We're not going to turn up every year, once a year, and just say, hi, nice to see you again. Let's re-sign the documents. We're going to have an active relationship. And that's very much what we have with the partnership. Every day, the various stakeholders communicating, opining, helping. And that's the kind of relationship we want with all of our partners.
I mean, that's going to be interesting, because it'll be something that I'm sure will really appeal to certain type of underwriter, but it might not appeal to some others who say, well, actually, I want to be left alone and only have to talk about it once every few quarters.
Absolutely. And we understand that. So it's all about getting the right risk selector. So we are a capital allocator, and the two things have to match. It has to be a partnership. And if people are not necessarily happy with the alignment or the oversight, it's just not going to work. But that's how we operate. Yeah. So all about matching capital to the right risk.
It's also interesting, I think, if you're an underwriter with an MGA looking for capacity, you're sort of the only ultra-focused capital allocator in town. If you see what I mean, they know exactly what you do. This is what you do. Yeah. So they know they've come to the right place. Obviously, they can't guarantee that you're going to want to back them, that you really like what they're going to do, or that what they do is going to fit in with your philosophy or your diversification strategy or whatever it is, or it might not clash with what you've already got. But at least they'll know you're 100% focused, because this is what you do. It's not as if you do this and lots of underwriting for your own accounts and all this other stuff. It's interesting to be that shop. You're the only sort of shop in the high street that says very specifically, if you want capacity for delegated underwriting, this is your shop.
Exactly. And we're not passive, we're going to be active. But what we offer is long-term partnership. We have a 10-year rolling binder with the Fidelis partnership. I'm not suggesting we would enter into a similar agreement, but we will look multi-year. We're not looking for a one-hit, one-year wonder. We're looking for long-term engagement.
So again, that's an attractive proposition for the right kind of underwriters. If you're looking for multi-year, they don't have to worry about getting caught short if the market changes or appetites change in the way that they do sometimes. And of course, it's the only real downside of being an underwriter without your own capital is that you can't back yourself when the market has decided to run away. If the market's sort of got the heebie-jeebies about something and you're thinking, oh, I wish they'd just calm down. We're going to be fine and we need to hold our nerve here. But you're a standard MGA at that point, it can just be a very difficult 3112 sometimes. And you think, goodness me, where are all my friends?
Yeah, and look, we've been around the best part of 4 decades. We've got a very experienced team here. We know how the cycle operates. So when we move into a relationship, we are looking 2, 3, 4, 5 years ahead. And we understand the challenges that may come in more competitive markets and how we're going to deal with that. So we're there with you on that journey.
We're there now, aren't we?
Yeah.
It's been really interesting because if I go back to, say, last year's Monte Carlo, it was a very bullish time. Obviously, it could not be. We come off great results. Everything's rate adequate, more or less, and everybody's looking to write a bit more. And lo and behold, what inevitably happened was the market softened, and it softened by more than most people were expecting. That seems to have taken a lot of people by surprise sort of in their commentary in Q1, Q2. Did it take you by surprise? I mean, I wouldn't have expected it to.
I think it depends where you sit in the food chain. And we talk about verticalized markets, the importance of being a leader, a price setter, not a price taker. So yes, we see the headlines. In my prior life as a broker, I helped write some of those headlines for many years. But, we're definitely seeing in certain lines a far more competitive markets. I think that's helped somewhat by your ability to match that with outwards reinsurance. And we talk very openly about that being a very fungible form of capital for us. And that can improve the inwards margin. I think the retrocession market in property has been the most competitive probably for the last 18 months. But I think as expected, we plan for a more competitive landscape, but we do use our outwards program. We can reshape the inwards and don't get too obsessed. The market is obsessed with property cat, property insurance. We write well over 100 different lines of business. Many of the lines that we're active in don't respond to the same market cycles as some of those more commodity-driven lines.
I suppose, the more specialty, probably less of a cycle they have because they're probably still in such a growth phase that it's still quite young products.
Exactly. So you've got to look at your portfolio as a whole. Yes, there is more competition in some lines of business. We talked about aviation being particularly disappointing for us. But when we look at property cat, property insurance, those 2 lines still have a very good margin. We still see that market akin to 22, 23, when everyone told us that was a great time to grow. But actually the difference, the outwards reinsurance is now available and in fact is, as I said, more competitive. So that's helping to improve margin as well.
And it can be much smoother. I mean, you can make it far more predictable, can't you? I suppose to know that if you put that line down with that protection behind it, it's going to be okay.
Yeah, Richard and I talked about it the other day. You really have in the last 2 or 3 quarters seen the reappearance of the facultative market. And there is capital out there that necessarily don't have the teams, the access to some of the business through the front door, but they're happy to take the risk on the facultative business. So you can write and buy, and that's improving your margin. And if it's at 80% of the upfront premium, it's back to back, that is improving your inwards margin on our portfolio. So we're very active in that market as well.
Yeah, but in terms of the market itself, you didn't have a negative. I suppose what I was talking about earlier about people having that negative surprise to say, oh, it softened quicker than I thought it was, is therefore a negative. It's a negative surprise. And that can change people's behavior. But with you, it hasn't.
Just more focused on, do we reshape how we deploy the capital? Do we look at different lines at different levels, different sorts of products? You can move more into the proportional, where you are seeing that original rate come through in certain territories. So you've got to be very fluid about how you deploy. You've got to be nimble. Many people aren't nimble. Many people work in silos. They're not actually reviewing the rating environment until a month or 2 months later. Well, as you know, we have a daily underwriting call. We're looking at it before we put our line down. We've audited it. We've thought about it. We've leveraged. We've looked for...
You already know what the outwards is going to look like.
Exactly. So you're able to maintain margin as best you can, but it is a more competitive landscape.
But then as a buyer of reinsurance, it sounds like you're much happier. If some of the products that kind of went away when you had that reset market, that 1/1/23, particularly that hard reset,
Yeah.
or some of those aggregate covers, all the sorts of different things that sort of evaporate in a hard market.
Yeah.
Are they back now?
To varying degrees. When we think about the inwards portfolio, what has been robust are the terms and conditions that everyone's fought very hard retentions to maintain over the last 6 or 7 years. They are being maintained. I think what hurt the market were the kind of high volatility earnings protections.
It's something that seems like every other quarter something was getting whacked.
Yeah,
and
exactly.
It probably shouldn't have been.
Yeah, exactly. And, we are here to take sensible retentions and manage our portfolio accordingly with good rates. We haven't quite got there yet, but of course we would be a buyer of sensible earnings protections when that market opens up.
And would you sell them?
Never say never, but I think we're more likely to be a buyer of that product than a seller.
I mean, I suppose that's how you see yourself as being the originator. If you're the lead underwriter, you're the originator of that risk and therefore the one who wants to lay it off rather than...
Yeah, exactly. And over 80% of the book is specialty bespoke insurance. So we're heavily focused on those lines of business, which would lead us more to be a buyer, I guess.
It doesn't sound like we're in a risk-off mode. You sound like you're still quite happy because of the way the outwards is working. We're not in the mode yet where you're sort of looking to de-risk, stop growing. It doesn't sound like we're in that kind of phase at all.
Again, it's this fixation around cat reinsurance.
Yeah.
There are so many other lines to grow in that are not affected by these cycles. So we see opportunity. It could be geographical, asset-backed finance, structured credit, those lines of business.
There's so much stuff.
Yeah, there's so much stuff. And we're very excited about that.
I had an amazing podcast very recently with someone in the M&A insurance world and quietly crept up to being sort of $10 to $12 billion. And obviously we get incredibly excited about cyber at about $16 billion. Well, this one, it's something that also is one of those lines that people don't always think is necessary for them because they think you have to be a lawyer or always have to be something. Do you think, well, actually, if you're looking for opportunity, this is an incredibly good opportunity. And it's one that,
absolutely. And again, we're active in those lines.
and obviously it's incredibly competitive, but it's a good line of business.
Yeah, and it's all about picking the right partners. So we have connections in that sector. But yeah, look, there's growth across the portfolio. I think we can manage margin where there is more focus on rate in the market. And again, I'm thinking about insurance and reinsurance property. But they're still very attractive high margin business.
Yep. We're also not in the sort of big special dividend type territory either. Well, other than obviously, if you're having a brilliant year, why not?
Well, it's a very interesting question because if we can all look at
capital return.
Yeah. If you look at the last earnings season, very good combined ratios with probably lower than expected ROEs because people are sitting on a lot of capital. So you've got to use that capital. You don't want to be forced into writing business you don't want to write. So it would make sense to either look towards maybe M&A, look towards other uses of capital. And we're laser focused on that. We know we've had a very strong share repurchase program for the last couple of years. We've been able to grow our book value considerably in that period. It's something like in the last 2 or 3 years, it's about 65%. Last quarter was the largest single increase in a quarter, 7%. And that's all through capital management. So it's not just about the underwriting. It's what are you doing with your surplus capital? Are you able to make a good return on that as well? So yeah, I would have thought there will be specials out there for some markets.
And of course, even if you were over-prudently, over-reserving, that doesn't make your return on capital any good.
No, certainly not.
It's nice to have, obviously. It's always nice to be about as over-reserved as you think you're allowed to be, I suppose, just in case.
Exactly. But, capital, surplus capital, we will always look to buy back stock if we're below book. We think we're a stock that should be trading above book. We've been very active in that market and we'll continue to do that.
Yes, it's the ultimate, simplest arbitrage in the world, isn't it? If you're buying some assets for a discount, then I'll have the discount. Thank you very much.
Exactly. And it's about being nimble, pivoting at the right time, having that conviction, but having the capital to do it. And through prudent management, we're in a strong capital position.
Where are the little pockets within the market widely that you're most happy with? It sounds like, because you've got 98 different pockets, that you're happy with all of them. Is that fair?
We've talked long and hard over the last 3 or 4 quarters about some lines, aviation being one of them. We're finding that tougher. But generally, we see pockets of opportunity across most lines of business. Now, can be product-driven, geography-driven. There could be an opportunity with a new partner who has a slightly different distribution network that we can access. So I think we're in a different position to some people in the market because we can now use different outlets to access good business, which is out there. You've just got to work hard to find it, and the hit ratio will be very low.
Often at this time of market, it's the time when brokers who've got good ideas can go to their favourite underwriters and say, look, we know that this is probably the right time. This is a product that's time has come. Or underwriters are more likely to at least say, yes, come, let's have a meeting, let's have a talk about this. This sounds interesting. Whereas 123, more likely to say, can you go away? We're really busy doing bread and butter stuff. We don't want all the jam tomorrow stuff. Whereas today is a time when a broker can have those kind of conversations about innovative ideas, new products, that kind of thing. Are there any new lines or those kind of discussions that you're getting excited about? Because there's a lot going on at the moment. It's really interesting.
Yeah, and brokers are very good at thinking, how can they grow the market,
ultimately,
right?
you know, they're the ones talking to the client. The client's saying, I've got this new problem. It's carbon credits. I don't know how to insure them. Can I insure them? And the broker says, I don't know, but I'll go and have a chat with Dan.
And I hope that the market will see that, you know, Fidelis as a business and the individuals and teams within it have built a reputation of innovation. We're carrying that through at Pelagos. So we're very happy to put the work in, talk to people. And, you know, this industry is all about finding solutions. There are a lot of challenges that range from climate change to macroeconomic, geopolitical, AI.
You're sort of in the sweet spot of all these things because, you know, if it's a product that requires a bit of a blend of all these things, something like carbon credits is a perfect example because it's a bit of political risk, a bit of this, a bit of that. It's a really interesting product, but it's almost a twist on what's already there.
Yeah, and I think we all recognise that working in silos, you will not find the solutions for those challenges that will touch different parts of your business. So working as a team, what I can say about Pelagos is the executive team look at every single partnership that we have, and we want to continue to do that. So we're not going to have hundreds of different partners. We'll have a manageable number to scale. So having a team that can look at everything together and bring all their different abilities, capabilities, experience to bear on everything that we do is really important, but you've got to put the time in. A lot of these things aren't going to work and they're quick answers. They don't get past the first phone call, but we will put the time in with brokers who are energetic and have thoughtful ideas.
Are there any specifically that
I think, as we've said, you know, many times, the asset-backed finance is really interesting. Some of the subsets under that, structured credit. So yeah, there are a few things out there that we're working on. Don't want to give the game too much, but
fair enough.
There's always long-term projects going on.
I'll wait for the announcements and we can talk about them then once they're out.
You'll get the first call.
No, but that's the thing. That's the nature of the beast. It's fine. Obviously, Dan, you're a constructor of portfolios and allocator of capital. Another thing that's innovation. It's not necessarily the most innovative innovation, but it's been really interesting, particularly in the London market. It's been the emergence of this portfolio solutions underwriting. And, you know, I've had people on the podcast and you're talking about billions of dollars of business now being written in this form, probably not that many people actually doing the writing. This is something that could be an allocation of your capital because maybe it makes sense, you know, because you've got all the skills.
Exactly. Our partnerships are all about portfolio level solutions. So we've been doing that for the last 3 years. It just happens that it's probably the most complex portfolio, or certainly one of them in the market. So yeah, we think we have the skill sets to look at this business because we understand the very broad underlying portfolios and how to manage them. So yeah, we see that as a real area of growth.
So absolutely yes, and you're open for business. It's not you're going to write every broker facility willy-nilly.
No. The broker facilities are a little bit more challenging for us. We still think there are good underwriting teams out there looking at this business that we can support, but the same criteria, the same characteristics in terms of what we're looking for in partnerships, in terms of alignment, that the underwriting teams have a good track record, they have access in a slightly differentiated way, and they're long-term, that still applies.
It's always the famous last words in any cycle is to say it's slightly different this time. But of course, the fact it is always slightly different each time because we're now in the future and it's not like it used to be. The interesting now is when I talk to those brokers, of course, I suppose they would say that, but the idea that some of these facilities, they've invested a huge amount of time, technological investment, they've turned these into a pillar of their business, that the idea of the old sort of like 1980s sort of broker facility that you might get burnt in a soft market and kind of fall by the wayside and then kind of get resurrected when the market's recovered, it doesn't seem to be an option for them. They said, well, Mark, that's not an option for us anymore because it's such a fundamental pillar of our business.
Yeah.
It's sort of like cutting one of our legs off because we don't want to go back, you know, because this is great. My brokers are so much more productive. I'm already placing 20 to 25%, 30% of my business this way. If I lost that, I would be in crisis. So at least in terms of alignment, they seem to have better alignment than they did before.
And yeah, you've hit the nail on the head. The word alignment is critical when you're looking
They
at those
don't want it to fall by the wayside,
exactly.
because they've put so much effort into it, and it's saving them so much time and obviously improving their own returns. Do you feel at least that when they tell you that you believe them?
I think if you can prove out the alignment theory, which means you need a track record, then yes, that ticks the box for us. Without that, we would not touch those sorts of facilities.
But then I suppose you want to be backing underwriters who are leading, and you want to be leading and following, then you get into sort of difficult aggregation position and you start to think, actually, am I writing this twice?
Exactly. We're looking for lead underwriting capability, but there are people out there doing that in the portfolio solutions space specifically. And with our skill set, we think we can manage that very well, but it will always come back to alignment.
And again, similar thing with consortia. They've always been here, but they seem to be having a good moment at the moment.
Yeah, look, why wouldn't a leader drive home their advantage? We all know it is a verticalized market, virtually in every line of business that we look at. You want to back the leaders. You don't want to be a price taker. That's important, and you get a differentiated outcome. So that has been proven out time and time again through the 4 decades that I've been in this
And you
industry.
make the leader a better leader because they've got more capacity.
Exactly, yeah. Give them leverage. Give them a bigger line size. They can drive home the terms. I've worked with Richard for 30 years and watched him do that. And that's really important differentiator that people need to recognise.
What about acquisition? It's the sort of thing that is happening in the marketplace. And sometimes it's cyclical because it's the right time to sell and get peak valuations round about this time when as the earnings all come through, but the new business is slightly not quite as good as it was and it seems a good time to sell. And also these days, because there's so much private equity in the market, some of this is just on its own timetable anyway. So it's not really cyclical. It's just that they have to sell or it's sort of time to sell because the fund says it is. Would it be right to rule you out of that kind of thing? Because it just doesn't seem to be your kind of bag and it never really has been.
No, I wouldn't necessarily rule us out. I think if the right opportunity came on, it's accretive. We have the capital to look at these and we get a lot of offers. Well, I think we all recognise we're at that point in the market where we expect more M&A, generally speaking. It's more difficult to grow for some, but we're focused on the underwriting growth first and foremost.
It's more likely to be sort of acquiring the capital. If you get a discounted capital.
No, not necessarily. I think we judge everything on its own merit. So there may well be opportunities to lean into certain classes or buy into good underwriting teams.
But if there were acquisitions, it's likely to acquire underwriters. And that would be a departure from being solely a capital allocator.
But capital allocator, there are many forms of how you want to allocate capital.
Yeah.
So for the right opportunity, we could consider it. At the moment, we see plenty of opportunity on the underwriting side, and then obviously opportunity to continue with a share repurchase scheme.
Yeah, I mean, because if there's always a good opportunity, I suppose you're going to weigh it, which is best value.
Exactly right.
And that equation's always changing, isn't it? I mean,
yeah, exactly. So for the right opportunity, we'll always consider it.
Well, it's good that you never rule anything out. I think it's sensible. What about AI? The good thing about AI now is that 2 years ago, probably when ChatGPT suddenly exploded onto everyone's consciousness, I could ask you, you were sort of experimenting with AI. And now I think we can get to the point where I can assume you've already been experimenting with AI. And now I can ask you about how it's gone and where the best use cases have been so far.
Well, I think when we look at AI, the biggest tangible benefit for us has been creating time to think, strategize, do other things within the business.
Because you've got all this data flowing all the time. So if you can get it to do the bread and butter work on that.
Exactly. And that could be supporting underwriting or the operational side, but you're able to farm data so much quicker than you've been able to in the past. So that buys you a lot more time to think about how you're going to apply that into your business. From an underwriting perspective, we're dealing with a lot of complex risk. It can help us form our decisions, but we're not quite there in terms of taking over the whole underwriting process. I'm not saying that will ever happen or not happen, but it's certainly a much more active
You haven't got sort of Agent Dan sitting in the corner.
No, but it's far more active informing us as to right underwriting decisions. But buying time is very important in a world that's very busy, and it gives you a distinct advantage.
Another thing, of course, is AI as a risk in itself. I know you're not really a casualty shop, but I mean, I know you do write cyber and other things. So what do you think about this emerging AI as a standalone new casualty peril? At least intellectually, it must be a nice thing to think about anyway. But because some interesting people are coming forward saying, we're going to underwrite this affirmatively.
Yeah, I think it's inevitable. And when it comes, it's going to be a major class of business. It will be a standalone business, but it will be of scale. And we are here as an industry to solve the challenges. Otherwise, we don't have a future, right? And we've had a lot of challenges in the last 2 or 3 years. And I think the industry has stood up very well. Be that conflict, macroeconomic issues, AI is going to be a challenge for the industry. But I think the industry is well placed to meet that challenge.
Dan, I've come to the end of my questions. Do you think there's anything that I should have asked you that I haven't?
Oh, I'm not going to tell you that, Mark. We see good margin in the industry. We see opportunity for growth at Pelagos. You've just got to work hard, work smart. It's as simple as that. It's not a complicated
You're not
business.
suddenly going to stop doing that, no?
No, certainly not.
Thank you, Dan. I've really enjoyed chatting.
It's great to see you, Mark. Thanks very much.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance is produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.